They just tried to pin silver to the floor again. Another paper shove, another "nothing to see here" headline. But the problem is, silver didn't stay down. It snapped back like a spring that's been compressed for years. And that snap is the tell. Something underneath the market is tightening, and 2026 is where that pressure could finally blow the lid off. We're not watching a bubble. We're watching a squeeze forming in slow motion. And the most dangerous part? Most people won't notice until the shelves look empty and the premiums don't make sense anymore. I'm going to lay this out cleanly. No fluff, no fairy tales. Fact. Silver is pushing into a new breakout zone, and it's behaving differently than it did in the past. Interpretation. The system is losing its ability to keep price suppressed for long stretches without inviting real demand to attack the dip. Quick disclaimer, this is educational. We manage risk. Now watch the timeline. Gold ran first, silver lagged. That lag made people complacent. It made people think silver was dead money. But lagging doesn't mean broken. It means coiled. And when a coiled market finally moves, it doesn't drift. It jumps. Here's the first thing we need to understand. Silver isn't just a chart. Silver is a physical supply chain with a paper costume on top. And when the costume tears, the market doesn't politely adjust. It gaps. So what actually happened? Silver pushed through major historical zones and refused to behave like an exhausted rally. The sell-offs that used to crush it for weeks or months, they're getting bought in hours. That isn't retail hype. That's structural demand showing up under the surface. And if that keeps happening, here's the open loop. What happens when the next smash meets a market that's already short on spare metal? Because the big move in silver doesn't start when everyone is excited. It starts when the people who need silver can't wait anymore. Let's talk about why 2026 matters without turning this into a bedtime story. Silver demand has two engines. One is monetary, the other is industrial. Most people only talk about one at a time, but the real danger is when both engines rev together. Monetary demand is simple. When confidence wobbles, people want something real. They want insurance they can hold. We've seen that movie before, and we're seeing early scenes again. Industrial demand is more brutal. Industry doesn't want silver. Industry needs it. It's not a luxury, it's a component. It's wiring, contacts, pastes, coatings, tiny pieces spread across 1,000 products. And the moment supply gets tight, the buyers with factories don't negotiate like coin collectors. They panic like manufacturers staring at a stalled assembly line. That's takeaway one. Silver is not just an investment trade, it's a production input. And production inputs don't politely wait for price to come down. Takeaway two is the weird one. Even if silver prices go crazy for a moment, $1,000, $2,000, even some ridiculous spike, those prices themselves trigger the counterattack, more supply. That sounds comforting, right? If it gets expensive, miners will just produce more. Here's the catch. Mining isn't a light switch. It's a ship. You can't turn it on instantly. You need permits, equipment, labor, financing, processing, transport. Even restarting old operations takes time. Starting new ones can take years. So the market can absolutely overshoot before supply responds. And overshoots are where fortunes and mistakes both get made. Now here's the contradiction that keeps people stuck. If silver can spike, why can't it stay there? Because markets hate free money. If silver stayed at extreme prices while the currency system still exists, the incentive would be so huge that production expands, substitution research accelerates, recycling ramps up where possible, and that eventually pushes price back down. So we're not betting on a permanent fantasy number. We're watching for a structural repricing cycle, an era where silver lives at higher levels because demand stays relentless while supply struggles to catch up. And that's where 2026 comes in. Right now, there are still pockets of metal. There are still sellers. There is still available inventory in places that matter to the retail crowd. Premiums exist, but they're not full-blown panic premiums everywhere. So the market can pretend everything is fine. But markets don't break when things are fine. They break at the moment flows flip. The flip is simple. When the public stops feeding metal back into the system and starts hoarding it at the same time industry keeps consuming it, that's the moment the price stops acting like a chart and starts acting like a rationing mechanism. Ask yourself this. If we wake up in 2026 and normal people finally decide silver is the one metal they can still afford, what happens when millions try to buy the same limited pool at the same time? And here's the second open loop. What happens when those buyers discover the paper price and the street price aren't the same thing? Because that's the part nobody wants to say out loud. A paper price is a headline. A physical price is what you actually pay. When those two drift apart, the headline becomes entertainment. Now, we also need to address the hype problem. Social media loves extremes. It loves the exchange explodes tomorrow content. It loves the end of the world countdown timer. We don't need that. We need signal. Fact. The system has pressure valves. Cash settlement exists. If a buyer demands delivery, exchanges have multiple ways to delay the optics of failure. They can change rules, raise requirements, widen margins, and try to make participation expensive. Interpretation. Those small changes are not proof the market is fine. They're proof the market is stressed enough that the referees are moving the goalposts. Here's the mistake most people make. They think the market breaks in one dramatic day with fireworks. That's rare. More often, it breaks quietly, through friction. Higher margin requirements, more paperwork, slower delivery, temporary restrictions, safety measures, stability measures. If you're watching the price only, you miss the war. The war is in the plumbing. And that leads to takeaway 3. The biggest moves come after the system adds bumpers to slow the crowd. Think of a casino that starts limiting how much you can bet because too many players are winning. The casino doesn't announce, "We're about to lose," it just changes the rules. Now, let's talk about regional pricing, because this is the part that turns manipulation into a liability. In a perfectly controlled world, there's one price. Everywhere. Instantly. But we don't live in that world. We're already seeing price separation. Different hubs start trading with different premiums based on local demand, local supply, and local constraints. One place has metal. Another place has hunger. The global price becomes a debate. And once that separation starts, it can widen. Here's why that matters. If one region pays more for physical, arbitrage wakes up. Traders smell free money. They buy where it's cheap, sell where it's expensive, and the act of doing that forces prices to converge. That convergence doesn't happen gently. It happens through aggressive buying in the cheap market. So when someone tries to smash paper down, but another region keeps paying up for real metal, the smash becomes a sale, and sales get cleared. Now we're back to 2026 again. Because if regional gaps widen at the same time the public flips from sellers to buyers, we get a nasty combination. Demand surge plus forced convergence. That's when the chart starts printing candles that don't look real. Let's pause here with a question that matters. If silver is so abundant, why do we keep hearing about tightening supply and critical mineral status? Because abundance on paper is not the same as deliverable metal at the right purity, in the right form, at the right time. A mountain of ore is not a bar in a vault. A forecast is not a shipment. A promise is not a delivery. And that's what critical mineral status really signals. It signals that governments and industries are waking up to dependency. It signals they may restrict exports, prioritize domestic use, or interfere with flows when shortages show up. We don't have to assume conspiracy. We just have to assume self-interest. If a country decides its industry needs silver more than the global market does, it can pull levers. Licenses, taxes, quotas, environmental delays, national security language. And that becomes the silent squeeze. Not a dramatic headline, a slow tightening. Now the big question everyone wants to ask is the price question. Can silver go to $5,000? Here's how we handle it without getting stupid. Possible. Silver can overshoot to extreme levels in a crisis moment. Markets do that. Thin markets do that violently. Likely. If the currency system is still functional, those extremes won't hold because the incentive to expand supply becomes massive. Certain. Before supply expands, the market can get chaotic because mining supply takes time. So the rational way to think about it is not, will we hit an insane number and stay there? The rational way is, where does the shortage show first, and how quickly does it spread? If we're wrong, where will it show first? It will show in premiums, delays, and regional dislocations before it shows in a clean, pretty chart. So what should we actually watch? Watch how fast dips get bought. When sell-off stops sticking, that's a clue. Watch retail flow. Are holders still selling back into the system, or are they locking it away? Watch industrial headlines and procurement behavior. When manufacturers start talking about securing supply, that's not marketing. That's fear management. Watch rule changes. When the gatekeepers raise requirements, they're preparing for volatility. And watch the gold-silver relationship. Silver has a history of lagging and then sprinting. That sprint is what rebalances the relationship, and it tends to happen when people least expect it. Now, we need to talk about the lever everyone ignores, time. People hear mine expansion and imagine a switch. Flip it, more silver. Real life doesn't work like that. Permits, equipment, power, water, labor, financing, processing, everything takes time. Even restarting a parked operation can take months. Starting a new mine can take years. And there's a second problem. A lot of silver isn't mined because someone chose silver. It's mined as a byproduct of other metals. So even if silver prices explode, supply doesn't automatically surge because the operator might be reacting to copper, lead, or zinc economics. Silver can be screaming while the mine still refuses to scale. That delay is where markets do their ugliest work. Here's an open loop we can't ignore. What happens if demand speeds up faster than supply can respond? But the paper market keeps pretending supply is infinite. Paper can create the illusion of abundance. Physical can't. That's why we keep seeing these sharp smashes that look engineered. They aren't trying to convince long-term holders. They're trying to scare the marginal buyer. They're trying to stop the stampede before it starts. And the clue that matters is simple. When the smashes stop working, the buyer isn't marginal anymore. Either the buyer has conviction or the buyer has a deadline. Manufacturers have deadlines. They have production schedules and penalties. They can't wait for a better price if waiting shuts down a line. That's why industrial demand is the quiet killer. It doesn't care about your chart. It cares about deliveries. Now, about substitution. People love to say they'll just replace silver. Sometimes yes, often no. Silver gets used because it performs. Conductivity, reliability, heat behavior, corrosion resistance. You can replace it in some applications, but you usually pay a price in efficiency, durability, safety, or size. Substitution is a trade-off, not a rescue plan. Then there's the stockpile myth. There's plenty above ground. Maybe, but much of it is scattered in tiny amounts across devices. Recovering it is hard and often uneconomic. So above-ground supply can be technically real and practically useless in a shortage. So what do we do with all this? We stop obsessing over a fantasy number. We watch the phases. First, disbelief. This is fake. Then, annoyance. It keeps going without me. Then, panic. I need in now. Then, chaos. Why can't I get filled? The crowd arrives in panic. Positioning happens in disbelief and annoyance. And yes, the system can slow panic with volatility. Margin hikes, fear headlines, paper floods. But it cannot manufacture physical metal overnight. So we act like engineers, not gamblers. We focus on signals that appear before the headlines: premiums, delivery times, regional gaps, and rule changes. We respect volatility as a weapon designed to exhaust you. Now, one last warning. When the real move starts, it won't give you comfortable entry points. It will feel unfair. It will feel like you're always late. That's how shortage markets behave. So the question isn't, will there be another dip? The question is, will the next dip be the last dip that comes with available metal? Because once the perception flips from, I can buy any time, to, I might not be able to buy, price becomes secondary. Access becomes everything. And that is where 2026 can turn from a date on a calendar into an event. If you want me to keep tracking those signals with you, hit subscribe and stay with our community. And tell me in the comments, what's the first place you think the shortage shows up? Premiums, delivery times, or a sudden regional price gap? Be specific. I'll read.